There is a giant sucking sound coming from the east. It is a sound that most Western investors are completely ignoring because they are too busy staring at the red candles on their screens. They are too busy worrying about the Federal Reserve's next quarter-point rate hike. They are too busy panicking over a temporary dip in the paper price of silver. But if you listen closely, if you tune out the noise of the New York Stock Exchange and the London Metal Exchange, you can hear it. It is the sound of thousands of tons of physical silver leaving the vaults of the West and traveling across the ocean to the vaults of the East. It is the sound of a vacuum cleaner, the size of a continent, turned on high power, draining the global supply of the most indispensable metal on Earth. China is not just buying silver, they are inhaling it. And the implications of this massive strategic accumulation are far more profound, far more dangerous, and far more bullish than any short-term chart pattern could ever show you. We are living through a tectonic shift in the global monetary order. For the last 50 years, the United States dollar has been the sun around which the financial solar system revolves. But gravity is shifting. The BRICS nations, led by China, are building a new center of gravity. They are tired of holding paper promises that can be sanctioned, seized, or inflated away. They want assets, real assets, hard assets, assets that do not rely on the good faith of a politician in Washington. And while everyone talks about their gold accumulation, almost no one is talking about their silver accumulation. But the numbers coming out of the Shanghai Gold Exchange tell a story that should make every silver stacker in the world sit up and pay attention. We are witnessing the weaponization of silver, not as a bomb, but as a shield against the dying light of the fiat currency experiment. Today we are going to dive deep into the mystery of the Shanghai Premium. We are going to explore why silver costs 10 to 15% more in China than it does in New York, and why this price gap is the most important signal in the entire commodities market. We are going to debunk the myths about a silver-backed yuan, while exposing the even more bullish reality of what China is actually doing. And we are going to explain why this flow of metal from west to east is irreversible, inevitable, and the ultimate catalyst for the repricing of silver in the years to come. Let's start with the mechanism that is driving this flow: arbitrage. It is a fancy word for a simple concept. If you can buy an apple in New York for $1 and sell it in Shanghai for $1.20, you will buy every apple in New York and ship it to Shanghai until the prices equalize. This is what is happening with silver. The spot price in China has been consistently, persistently higher than the spot price in the West. This premium acts like a magnet. It pulls the metal out of the COMEX vaults, out of the LBMA vaults, and onto ships bound for Asia. But why? Why is China willing to pay so much more for silver? The mainstream financial press will tell you it's just industrial demand. They will tell you it's because China makes all the solar panels. And yes, that is part of it. China is the factory of the world. They need silver to keep the lights on and the production lines running. But industrial demand alone does not explain a persistent double-digit premium that lasts for months. Industrial users are price sensitive. If the price gets too high, they usually pull back. But China is not pulling back. They are accelerating. This suggests something deeper. It suggests a monetary motivation. It suggests that the Chinese people, and perhaps the Chinese state, view silver not just as a commodity, but as a store of wealth. In a country where the property market is collapsing, where the stock market is volatile, and where capital controls prevent you from moving your money out of the country, where do you put your savings? You put them in gold beans, and you put them in silver bars. The Chinese public is waking up to the safety of precious metals at the exact same moment that the Western public is forgetting it. This cultural difference is creating a massive divergence in demand. In the West, we sell silver when the price drops because we view it as a trade. In the East, they buy silver when the price drops because they view it as a discount on savings. This sticky demand creates a floor under the market that the paper shorts cannot break. Now let's address the elephant in the room, the rumors of a silver-backed yuan. You will see this all over the internet. People claiming that China is going to announce a new currency backed by a basket of commodities, including silver, on Tuesday morning. I want to be the voice of reason here. The probability of China officially pegging their currency to silver in the near term is near zero. Why? Because pegging your currency to a commodity restricts your ability to print money. It ties the hands of the central bank. No government, especially not an authoritarian one facing an economic slowdown, wants to tie its own hands. They want the freedom to stimulate, to bail out, to manage the economy. However, the reality is actually more bullish than the fantasy. China doesn't need to back the yuan with silver to destroy the dollar's dominance. They just need to own the silver. By cornering the market on strategic commodities, silver, gold, copper, rare earths, China gains leverage. If they control the supply of the metal that is essential for the green energy transition and the high-tech military of the future, they control the choke points of the global economy. They don't need a gold standard, they need a control standard. Imagine a scenario where the United States wants to build a new fleet of missiles or a vast array of solar farms to meet its climate goals, but it cannot source the silver because the stockpiles are in Shanghai. China can then dictate the terms. They can say, "We will sell you the silver, but you must pay in yuan." This forces the world to hold yuan, not because it is backed by gold, but because it is the only ticket to get the resources you need. This is the petro-yuan strategy applied to metals. It is a slow, methodical strangulation of the dollar's utility. This strategy explains the relentless buying. It explains the premiums. It explains why they are draining the West. They are converting their massive trade surplus, which used to be recycled into U.S. Treasury bonds, into hard assets. They are trading paper promises for physical reality. Every ounce of silver that leaves New York and arrives in Shanghai is a vote of no confidence in the U.S. debt market. It is a silent revolution. We also need to look at the industrial security angle. China remembers history. They remember the century of humiliation. They are obsessed with security, food security, energy security, resource security. They know that silver is the Achilles heel of the modern economy. Without it, the electronics industry grinds to a halt. By stockpiling silver, they are insulating themselves against future supply shocks or sanctions. If a war breaks out over Taiwan and the shipping lanes are closed, China wants to ensure it has enough raw materials to keep its war machine and its economy running for years. The massive silver purchases are, in essence, a form of war preparation. This is a sobering thought, but it is a necessary one for the investor. Geopolitical tension is inflationary, war is inflationary, preparation for war is resource intensive. All of these vectors point to higher commodity prices. The peace dividend of the last 30 years is over. We are entering an era of resource nationalism. In this era, the price of silver will not be set by the marginal cost of production. It will be set by the marginal cost of security. What is a country willing to pay to ensure it survives? The answer is anything. The Shanghai premium acts as a leading indicator for the global price. Eventually, the arbitrage will close. But it won't close by Shanghai prices falling. It will close by Western prices rising. The physical drain will eventually cause a delivery failure in London or New York. A major industrial user will ask for their metal, and the vault operator will say, "I'm sorry, it's on a boat to China." When that news breaks, the paper price in the West will gap up violently to match the physical reality in the East. This is the repricing event we are all waiting for. It is important to understand that this is not a conspiracy theory. It is simple game theory. If you are China and you see your rival, the US, printing trillions of dollars, debasing its currency, and weaponizing its financial system, what is the rational move? The rational move is to exit that rival's system and build your own. And the foundation of any independent system is independent assets. Gold and silver are the only financial assets that are not someone else's liability. They are the only assets that are permissionless. The flow of silver is also a symptom of the definancialization of the global economy. For decades, the financial economy, stocks, bonds, derivatives, grew faster than the real economy. We traded paper back and forth and called it wealth. But now, the pendulum is swinging back. Real things matter again. You can't eat Bitcoin. You can't build a house with a stock certificate. You can't conduct electricity with a treasury bond. As the world wakes up to the scarcity of real things, the value of those things relative to paper assets must rise. China is just waking up faster than we are. So, what does this mean for you, the individual investor sitting in the West? It means you are competing with a superpower for the same limited resource. It means that every time you buy an ounce of silver, you are front-running the Chinese state. You are securing your own personal strategic reserve before the window closes. The fact that you can still buy silver at under $35 an ounce in paper terms is a miracle. It is a temporary anomaly caused by the suppression of the paper market. But China is exploiting that anomaly every single day. They are thanking the Western banks for keeping the price low while they back up the truck. You should be doing the same. You should be viewing the paper price not as the value of your wealth, but as the acquisition cost of your future wealth. If the COMEX wants to sell you silver at a discount to what China is paying, you should take that deal every day of the week and twice on Sunday. You should be the arbitrageur in your own life. Buy the undervalued asset in the West and hold it until the global price resets to the East's reality. Let's talk about the sticky nature of Asian demand. In the West, when the price of silver goes up, people tend to sell. We treat it like a stock. We take profits. In Asia, specifically in India and China, higher prices often lead to more buying. It validates the asset. It creates a Veblen good effect where the higher price makes it more desirable. And once they buy it, they rarely sell it. It goes into the family jewelry, it goes into the temple, it goes into the corporate stockpile. It leaves the market permanently. This removes the overhang of supply. It tightens the market structurally. The west to east flow is a one-way street. The silver bars that go to Shanghai are likely never coming back. They are being melted down and turned into industrial components or stored in deep vaults that will not be opened for decades. This means the Western liquidity pool is shrinking. The free float of silver, the amount available for trading, is collapsing. When the free float gets low enough, volatility explodes. We saw a preview of this with the recent flash crash and rebound. Small moves in sentiment now create massive moves in price because the liquidity buffer is gone. We also need to consider the yuan internationalization. China wants the yuan to be a global trade currency. To do that, they need to build trust. Since they don't have the rule of law or the open markets of the West, they have to substitute trust with collateral. Holding massive reserves of gold and silver gives the yuan a credibility that fiat alone cannot provide. It signals to trade partners in the global South. Our money is good because we have the hard assets to defend it. This is a soft backing. It is a psychological backing, and it is very effective. Now let's debunk the silver standard myths a bit more thoroughly so we don't get carried away. A full silver standard would require a massive revaluation of silver, likely to thousands of dollars an ounce, to cover the money supply. While this is the dream of every stacker, it would also cause massive deflationary shocks to the Chinese export economy. China wants a stable currency, not a hyperdeflationary one. So do not bet your life savings on a formal announcement next week. Bet on the trend. The trend is accumulation. The trend is scarcity. The trend is higher prices over time, driven by strategic necessity. The great metals crash we just witnessed was likely exacerbated by this flow. How? Because as the metal leaves the COMEX, the open interest, the paper bets, becomes more and more unbacked. The ratio of paper ounces to physical ounces explodes. This makes the system fragile. A small gust of wind can knock it over. The banks know this. They are terrified of it, so they slam the price to try and shake out the paper longs and reduce the open interest. They are trying to deleverage the casino before it burns down. But every time they slam the price, China buys more physical. It is a trap. The banks are trapped between a paper collapse and a physical run. This is the end game. The paper market tries to suppress the price to save the dollar system, but the suppression only accelerates the physical drain to the east, which ultimately destroys the dollar system. It is a paradox with only one resolution: a break in the peg, a moment where the paper market fails and the physical price goes vertical. For the stacker, this information is vital. It tells you that you are not alone. You are not just a crazy person hoarding metal in your basement. You are aligned with the strategic direction of the world's rising superpower. You are aligned with the laws of physics. You are aligned with history. The smart money is not on Wall Street anymore. It is in Shanghai, Mumbai, and Singapore, and they are buying what you are buying. The Shanghai premium is also a warning to the industrial users in the West. If Apple and Tesla and Samsung want silver, they are competing with Chinese state-backed entities that are willing to pay a premium. Eventually, the Western companies will have to pay that premium too. They will have to bid up the price to keep the metal in the West. This will trigger the industrial panic buying that leads to the mania phase of the bull market. So, what should you do? Watch the premiums, not just the premiums at your local coin shop, but the premiums in Shanghai. As long as that gap exists, the drain continues. As long as the drain continues, the floor under the silver price rises. The volatility will be extreme, as we just saw, but the trajectory is locked in. Do not let the short-term noise distract you from the long-term signal. The signal is that the East is draining the West. The signal is that silver is becoming a strategic asset. The signal is that the dollar is losing its privilege. This video analysis is not just about silver, it is about the changing of the guard. It is about the decline of one empire and the rise of another. And in times of transition, during the friction between empires, gold and silver are the only safe harbors. They are the only assets that are recognized by both sides, but trusted more than either side's paper promises. China's massive silver purchases are the smoking gun. They prove that the supply-demand data we see from the Silver Institute is likely understating the deficit. The official numbers often miss the private strategic accumulation. If you add the Chinese state buying to the industrial demand and the retail demand, the market is likely in a deficit of hundreds of millions of ounces. This cannot last. Something has to give, and that something is the price. Be patient. The transfer of wealth from west to east takes time. It is a slow bleed, not a sudden amputation. But the patient, the Western financial system, is getting weaker every day. The cure, higher prices, is coming. Hold your position. Do not sell your strategic reserve to the entity that is trying to corner the market. When you sell, you are helping China win. Keep your silver. Keep your sovereignty. The yuan backed by silver is a distraction. The yuan protected by silver is the reality, and the dollar destroyed by silver is the consequence. Stay vigilant. Watch the flows. Follow the physical. The paper game is ending. The physical game is just beginning.